Investing in the stock market can seem intimidating, especially for beginners. The sheer volume of information and the potential for loss can be overwhelming. But it's essential for building long-term wealth. Unlike a savings account, which offers minimal interest, stocks provide an opportunity for significant growth. Think of it as planting a seed for your future. Over time, your investments can grow, helping you achieve your financial goals. Just like a plant needs water and sunlight, your investments need time and patience. Whether it's buying a home, retiring comfortably, or securing your children's education, investing can help you get there. These milestones require substantial financial resources, and investing can provide the necessary growth. Imagine you put money in a savings account. It earns a little interest, but often not enough to keep up with inflation. Now, imagine investing that same amount in stocks. The potential for higher returns is much greater. Stocks have the potential to earn much more over time. This is because you're buying a small piece of ownership in companies. As these companies innovate and expand, your investment can grow exponentially. As those companies grow in profit, so can your investments. This growth can significantly outpace the returns from traditional savings accounts. Of course, investing always comes with risks. Market volatility can lead to short-term losses. The stock market can go up and down. It's important to stay informed and not panic during downturns. But remember, we're in this for the long haul. Just like a marathon, investing requires endurance and a long-term perspective. By investing consistently and making smart choices, you can weather market fluctuations and come out ahead. Regularly reviewing your portfolio and seeking professional advice can also help you stay on track. Before you jump into the stock market, let's cover some basics. Understanding these fundamentals will help you make informed decisions and avoid common pitfalls. A stock represents a small piece of ownership in a company. When you purchase a stock, you are essentially buying a tiny fraction of that company. When you buy stock, you become a shareholder. This means you have a claim on part of the company's assets and earnings. A portfolio is simply a collection of your different investments, like stocks, bonds, or real estate. It's important to have a well-rounded portfolio to balance potential risks and rewards. Diversification is key to managing risk. By spreading your investments across various assets, you reduce the impact of any single investment's poor performance. Imagine putting all your eggs in one basket. If that basket falls, you lose everything. If that basket falls, you lose everything. The same principle applies to investing. The same goes for investing. If you invest all your money in one stock, and it performs poorly, you could lose a significant amount of your investment. Diversifying means spreading your investments across different asset classes, industries, and even countries. This strategy helps to mitigate risks and can lead to more stable returns over time. This way, if one investment doesn't perform well, others can cushion the impact. Remember, knowledge is power. The more you understand about investing, the better prepared you'll be to make smart decisions. Before investing, take the time to understand the basics. There are many concepts and strategies that can help you succeed in the stock market. There are plenty of resources available online and through financial literacy programs. These can provide valuable insights and guidance. The more you know, the more confident you'll become in your investment decisions. Confidence comes from knowledge and experience, so keep learning and stay informed. Ready to start investing? The first step is opening an online brokerage account. This is your gateway to the stock market. Think of it like a bank account, but instead of holding just cash, it holds your investments. There are many online brokerage firms to choose from. Look for one that's reputable, easy to use, and offers low fees. Consider factors like trading commissions, account minimums, and research tools. Some popular online brokerages include Fidelity, Schwab, and Vanguard. Opening an account is usually quick and straightforward. You'll need to provide some personal information, like your social security number and employment details. Once your account is funded, you're ready to start buying and selling stocks. Now, the fun part, choosing your investments. This is where research comes in. Don't just buy a stock because everyone's talking about it. Take the time to understand the company, its business model, and its financial health. Start by looking at companies you're familiar with. Do you love a particular brand of coffee? Check out the company's stock. Are you passionate about renewable energy? Explore companies in that sector. Look at key financial metrics like revenue growth, earnings per share, and debt levels. Read company news and industry reports to stay informed. Remember, you're buying a piece of a business, so treat it like you're the owner. Section 5. Your roadmap to success setting investment goals. Before you start investing, it's crucial to define your investment goals. What are you saving for? A down payment on a house? Your retirement? Your children's education? Your goals will determine your investment timeline and risk tolerance. If you're saving for a short-term goal, like a down payment in a few years, you'll want to invest more conservatively. If you're investing for retirement decades from now, you can take on more risk. Write down your goals and how much you need to save. Then create a realistic investment plan to reach those goals. Having a clear roadmap will keep you motivated and on track. Section 6. Protecting your investments, risk management and diversification. In this section, we will delve into the importance of safeguarding your investments through effective risk management and the strategy of diversification. Remember that diversification is essential for managing risk. By spreading your investments across various assets, you can reduce the impact of any single investment's poor performance on your overall portfolio. Don't put all your eggs in one basket, or in this case, one stock. This age-old adage holds true in the world of investing. Concentrating your investments in a single stock or sector can expose you to significant risk. Spread your investments across different companies, industries, and asset classes. This way, if one sector underperforms, the others can help balance out the losses, providing a more stable return over time. Asset allocation is another crucial aspect of risk management. It involves dividing your investments among different asset classes to align with your financial goals and risk tolerance. This means dividing your investments among different asset classes, like stocks, bonds, and cash, based on your risk tolerance and time horizon. A well-balanced portfolio can help you achieve your financial objectives while managing risk. For example, a younger investor with a longer time horizon might allocate more to stocks, which have higher growth potential but also higher volatility. This approach can maximize growth over the long term. An older investor nearing retirement might allocate more to bonds, which are generally less volatile than stocks. This strategy helps preserve capital and generate steady income as they approach their retirement years. Remember, there's no one-size-fits-all approach to investing. Each investor's situation is unique, and your investment strategy should reflect your individual financial goals, risk tolerance, and time horizon. Your risk tolerance and asset allocation will be unique to you. It's important to regularly review and adjust your portfolio to ensure it remains aligned with your changing financial needs and market conditions. If you're unsure, consult with a financial advisor to create a personalized investment strategy. A professional can help you navigate the complexities of investing and develop a plan tailored to your specific circumstances and goals. Section 7. Staying the course, regular monitoring and adjustments. Once you've built your portfolio, it's not time to sit back and relax. Regular monitoring and adjustments are crucial for long-term success. Review your portfolio at least once a year or more frequently if market conditions change significantly. Make sure your investments are still aligned with your goals and risk tolerance. Rebalance your portfolio as needed to maintain your desired asset allocation. This might involve selling some investments that have performed well and buying more of those that have lagged. Remember, investing is a marathon, not a sprint. Stay disciplined, avoid emotional decisions, and stick to your long-term plan. The power of compounding long-term growth and patience. One of the most powerful concepts in investing is compounding. This is the process of earning interest on your interest, leading to exponential growth over time. The earlier you start investing, the more time your money has to compound. Let's say you invest $1,000 and earn a 7% annual return. After 1 year, you'll have $1,070. But after 10 years, you'll have over $1,967. After 30 years, your investment will be worth over $7,612. This is the magic of compounding. Don't underestimate the power of starting early and letting your investments grow over time. Patience is key. Ethical considerations. Socially responsible investing, SRI. Many investors today are interested in aligning their investments with their values. Socially responsible investing, or SRI, focuses on investing in companies that meet certain environmental, social, and governance criteria. For example, you might choose to invest in companies that promote renewable energy, support fair labor practices, or have strong corporate governance policies. There are many SRI funds and ETFs available that allow you to invest in companies that align with your values. Doing good while doing well is a win-win. Seeking expert advice. When to consult a financial advisor. While you can certainly learn to manage your investments yourself, there are times when seeking professional advice is beneficial. Consider consulting a financial advisor if you're nearing retirement, facing a major life event like a divorce or inheritance, feeling overwhelmed by investment decisions, or lacking the time or knowledge to manage your finances effectively. A qualified financial advisor can provide personalized guidance, create a comprehensive financial plan, and help you navigate complex financial situations. Start investing today. Your journey to financial freedom. Building a stock portfolio might seem daunting at first, but remember, every journey begins with a single step. Start by educating yourself, setting clear goals, and taking action. Open a brokerage account, invest consistently, and stay disciplined. Remember, investing is not just for the wealthy or financially savvy. It's for anyone who wants to take control of their financial future and build long-term wealth. Start today and let the power of compounding work its magic. Your future self will thank you.